Most people think a taxable brokerage account is just a retirement account without the age restriction. That is where the trouble starts, because a taxable brokerage is not just a 401k without the handcuffs. It is a different battlefield. It is an account where the same lazy thinking that can survive inside a retirement plan gets punished much faster, much more quietly, and much more expensively. You can buy the wrong asset, collect the wrong kind of income, trigger the wrong taxes, chase the wrong yield, and spend years congratulating yourself for investing while your portfolio leaks efficiency every single year. That is why I have never liked casual thinking around taxable investing. The account looks ordinary, the mistakes are not. I have watched people become very proud of owning income assets in taxable accounts while handing away a shocking amount of that income in unnecessary taxes. I have watched people chase flashy yields, collect fat monthly payouts, and then discover too late that the real yield they were receiving after tax was much less impressive than the fantasy they bought. I have watched people load up on bond funds because they wanted safety, only to learn that safety is not the same as tax efficiency. I have watched others treat a taxable brokerage as a random junk drawer of ETFs. A little of this, a little of that. Some international because it sounds sophisticated, some covered calls because the yield looks exciting, some aggressive growth because they do not want to miss out. And then they wonder why the whole structure feels confused. Confused structures rarely become wealthy structures. That is why I think a taxable brokerage deserves more respect than people give it. A retirement account is forgiving in one very important way. You can trade inside it, collect dividends inside it, let assets grow inside it, and the taxman is either deferred or, in the case of a Roth, largely shut out of the compounding process. A taxable account is different. In a taxable account, your decisions echo immediately into your taxes. Sell for a gain, and the government notices collect a dividend, and the government notices choose the wrong type of dividend, and the government notices even more. You are not only building wealth, you are managing friction. This is where adults separate from hobbyists. A hobbyist asks, what ETF looks good? An adult asks, what is this ETF going to do to my after-tax compounding over decades? That is the real question. The source document starts in exactly the right place. It says plainly that taxable brokerage investing is very different from retirement account investing because of one giant word: taxes inside a 401k ERA, or Roth ERA. The structure is tax-deferred or tax-free in a way that allows compounding to work with fewer interruptions. In a taxable brokerage, capital gains and dividends create tax consequences as you go. Even reinvested dividends can generate tax obligations because the distribution was still received. Fay-Felicite, Fay Turn 27, File 2 Fay, that sounds obvious when stated that way. Yet a remarkable number of people act as if the taxable account is just a freer version of the retirement account. It is not freer, it is looser, in some ways and harsher in others. Yes, you can pull money out whenever you like, which is a genuine advantage. You do not have to wait until 59 and a half. You do not have penalties just because life changed and you want your own money. Fine, that is a real benefit. But the price of that flexibility is that your portfolio is now exposed to the tax character of what you own. That phrase matters, tax character. Not all yield is created equal. Not all dividends are created equal. Not all income belongs in a taxable account. That is one of the biggest lies modern ETF culture encourages. It has trained people to look at yield before they look at tax character, distribution quality, structural purpose, or long-term fit. They see 10% and feel intelligent. They see a monthly payout and feel secure. They see a big distribution and imagine a smooth, beautiful retirement paycheck. But a taxable account is not impressed by feelings. A taxable account asks a colder question: what kind of distribution is this, and how will it be taxed? The source document makes this point with a very useful example. JEPQ, on the surface, it looks like a dream for the income, hungry investor, a fat yield monthly cash flow. The kind of fund that makes people feel as if they have found a secret shortcut. But dig one layer deeper and the magic begins to dissolve. Much of that payout is not qualified dividend income. It is taxed more like ordinary income, often at a much higher rate depending on your bracket, which can make it far less efficient in a taxable brokerage than the headline yield suggests. The file states directly that JEPQ is generally inefficient for taxable accounts and is better suited to tax-advantaged accounts like IRAs and 401ks because of those non-qualified monthly payouts. Fay-Felicite, Fay Turn 27, File 2 Fay, that is the kind of detail people skip when they are in love with yield. But that detail is everything. This is one of the reasons I have never liked talking about income without talking about after-tax reality. Gross yield is not what you live on. It is not even what you keep. What matters is what survives the combination of taxes, volatility, structural risk, and time. A man who collects 10% but loses a large piece of it to taxation and takes additional risk to get it may be doing much worse than the man who quietly owns high-quality assets with lower but more efficient income characteristics. This is where taxable investing becomes less exciting and more intelligent, less headline-driven, more architecture-driven, and that is how I prefer it. Now, if we are going to build a taxable brokerage the way an intelligent adult would build one, the first thing I want is not excitement. I want categories. The source file is actually very useful here because it divides the taxable account into roles rather than into random ticker symbols. That is exactly the right way to think. A taxable account should not be a bag of ideas. It should be a portfolio where each component has a job. The first job is value and qualified dividend exposure. This is not about chasing the highest payout available. It is about owning a category of companies that tend to be steadier, more recession-resistant, lower beta, and capable of producing qualified dividends that are taxed more favorably than ordinary income. In many cases, the file identifies SEG, VIM, and VTV as the main choices in this bucket, with SEG leaning more toward dividend cash flow and VTV leaning toward lower dividend tax drag and possibly more appreciation. Fay file site Fayturn 27 file 2 Fay. I think that framing is smart. People hear dividend ETF and immediately start thinking only about yield. That is childish. The more mature way to think is job description. What is this position doing inside the taxable brokerage? In this case, the job is not merely pay me cash. The job is also to stabilize the ride somewhat, reduce overall portfolio fragility, and provide an income stream that does not offend the tax structure as badly as some of the flashy alternatives. That matters because taxable investing is partly about staying invested. A portfolio that you cannot emotionally hold through bad markets is a portfolio you do not really own. Value and dividend-oriented exposures can help reduce the feeling that every dollar of your wealth depends on glamorous growth. They remind you that dull companies still exist, cash flows still exist, and the market is not only a circus of whatever grew the fastest in the last 18 months. Now, once that category is in place, people always ask where to hold cash. Again, the taxable account punishes laziness. A lot of people toss cash into a generic money market, feel responsible, and move on. Nothing terribly wrong with that. The file notes that money markets can be a reasonable place for cash, and we're yielding around the mid-3% range at the time of the source, while also warning that those rates change with the Fed cycle. But it also makes a more tactical point that I think many people miss. SCOV, the argument in the file is that SCOV can be especially attractive for someone in a high-tax state because it offers Treasury, bill-style yield, and state tax advantages that a generic cash solution may not. Fay file site Fayturn 27 file 2 Fay, that is a small point. It is also exactly the kind of small point that compounds taxable investing is full of those points. One decision alone will not make you rich, but repeated intelligent decisions, especially around tax drag, absolutely can. And this is also why the source says clearly that traditional bond ETFs do not really belong in a taxable brokerage in most cases. The interest is typically taxed as ordinary income, so the investor who imagines he is being safe by holding taxable bond funds there may actually be creating a clumsy structure from a tax perspective. Safety is not only about volatility, it is also about what you keep after the structure does its work. Fay file site Fayturn 27 file 2 Fay, that is a lesson many people learn too late. Now we come to the category that matters most over long stretches of time: foundation. If a taxable brokerage is going to work as an enduring wealth engine, it needs a core that can survive decades, crashes, recessions, panics, bubbles, stupidity, elections, wars, and the endless human habit of declaring every few years that this time is different. The source file does the right thing here by making the foundational bucket the SP 500 or total U.S. stock market bucket, represented by funds like VOO or VTI. Fay file site Fayturn 27 file 0 Fayturn 27 file 1 Fay. This is exactly where I would want the heaviest long-term trust placed, broad ownership, low fee, long history, thousands or at least hundreds of the strongest productive companies in the economy. That is not flashy, It is not supposed to be flashy. Broad ownership is the grown-up answer to the question of how to build wealth without constantly needing to prove how clever you are. The source makes the case by walking through the market's history of crashes and recoveries, even citing the long-run power of simply owning the broad market across horrors like the Great Depression and the financial crisis with dividends reinvested. FE file site FE turn 27. File 0 FE, that is not merely a history lesson. It is a temperament lesson. Markets are not kind enough to reward everyone who is right in theory. They disproportionately reward those who stay alive in practice. A foundational ETF position is not about bragging rights. It is about giving your taxable brokerage a spine, and the source is right that if two funds track the same index, then fee differences become one of the deciding factors. The real adult takeaway is not which ticker makes me feel smarter, but what exposure am I buying and at what cost. FE file site FE turn 27 file 0 FE turn 27 file 1 FE. I have always liked that kind of thinking. It removes ego. Now, a taxable account that only owns us broad market and nothing else is not automatically wrong. But the source correctly makes room for diversification outside the United States through a broad international fund such as VXUS. It is careful, however, not to romanticize the category. It explicitly says that international ETFs can outperform in certain years, and even notes that they did well in 2025, but also emphasizes that over long periods they have generally underperformed the U.S. market. The file positions VXUS not as a return champion but as a diversification tool and suggests keeping it to a lower percentage. FE file site FE turn 27 file 1 FE. That is exactly the kind of sober language I like. International exposure is often abused in one of two ways. Either people ignore it completely because the U.S. market has looked unbeatable in their recent memory, or they load up on it as though the simple fact of being global confers wisdom. Neither attitude is adult. Diversification is not a moral badge. It is a structural decision. If you already own the largest U.S. companies, you already own a good deal of global business activity indirectly. So the role of VXUS is not to rescue you from ignorance. It is to broaden the ownership base and reduce single country concentration somewhat. That is all. It is a role player, not the hero of the portfolio. Once that bucket exists, we move into the broad growth category where things get more interesting and also more dangerous if the investor becomes a little too excited. The source describes broad growth as the higher risk, higher reward side of the core, while still insisting it should remain diversified enough not to become a pure one-sector gamble. It identifies the NASDAQ 100 and QQQM specifically as a favored way to get this exposure, also mentioning SHE and VUG as excellent alternatives with lower fees and strong long-term growth profiles. FE file site FE turn 27 file 3 FE. I think the distinction the source makes here is very useful. Broad growth is not the same as speculative growth. It still belongs to the portfolio core. It still lays foundation. It still owns real companies with real scale. It is simply tilted more heavily toward faster growing sectors, especially technology, innovation, and higher beta opportunity. QQQM is a fine example of that. It is not a random basket of story stocks. It is a concentrated but still diversified slice of very powerful businesses. That is a different thing from gambling, and grown-ups should know the difference. One of the easiest mistakes in a taxable brokerage is to assume that because you have broad market exposure, you no longer need a growth tilt. That may or may not be true depending on your age, goals, and other accounts. But I do appreciate the file's willingness to separate foundation from broad growth, because in practice they do serve somewhat different psychological and structural roles. Foundation says endurance, broad growth says acceleration. One keeps you rooted, the other helps you participate more directly in the part of the market that, over long stretches, can create extraordinary upside. Of course, extraordinary upside always attracts foolishness, which is why I also respect that the source file labels the final category optional smaller and explicitly more volatile aggressive growth. It gives examples like SMH, XME, IBIT, and then says its personal favorite in that category is VGT because it offers more upside than the other categories while still being broader and somewhat less fragile than something ultra concentrated like a pure semiconductor bet. FE file site FE turn 27 file 5 FE. This is adult portfolio design. Not because it tells you to own aggressive growth, because it tells you where it belongs. If you do small, optional, risk aware. I cannot tell you how much damage people do by taking what should be a satellite position and turning it into the emotional center of the account. A taxable brokerage should not become a shrine to whatever ran hardest last year. The speculative slice, if it exists at all, should be there because you understand it, can survive it dropping 50%, and have already built the safer architecture around it. The source is very clear on that point. Sector-specific or theme, heavy ETFs can swing violently, and they should be treated accordingly. File Site Fe Turn 27 File 5 Fe, that is the difference between a portfolio and a pile of convictions. Now the part I liked most in the source file is that it did not stop at listing ETFs. It attempted to map them to actual investor situations. That is the right instinct. A taxable brokerage should not be built as though every investor is the same age, with the same tax profile, same risk tolerance, and same reason for opening the account. The first model in the file is the younger, higher-risk investor, roughly 30 or younger, trying to grow aggressively and possibly retire early. The suggested structure puts meaningful weight into value, foundation, broad growth, and a modest aggressive growth sleeve. Specifically, it proposes SCG, VOO, VXUS, QQM, and VGT, in a fairly growth, forward but still diversified mix. File Site Fe Turn 27 File 5 Fe. I understand why that structure would appeal. It says, I want long-term broad ownership, but I also want more upside than a pure vanilla portfolio. For a younger investor with time and tax flexibility, that can make sense. The key, however, is that the aggressive sleeve remains only a sleeve. This is what many younger people forget. Youth is not permission to be stupid. Youth is permission to let time help you. Broad market, broad growth, some value, some international, and a measured dose of aggressive growth can be a perfectly rational structure if the investor understands that patience, not adrenaline, is still doing most of the work. The second model in the file is perhaps the most interesting because it is the most adult. This is the investor in the 40s or 50s, likely in peak earning years, already using retirement accounts, now building a taxable brokerage with an eye toward possible early retirement tax awareness and somewhat moderated risk. The source shifts the value sleeve here from SHD to VTV specifically to lower dividend tax drag while keeping a safer value exposure. Then it blends in VXUS South Carolina HG and a smaller VGT position, File Site Fe Turn 27 File 5 Fe. That is excellent thinking. Not because VTV is better than SHD in some absolute sense, because the job changed. This is the mark of an adult mind, understanding that the same ETF is not automatically right for every stage of life, just because it is popular. A higher earner in the thick of his tax year should care more about tax character. A taxable brokerage for someone nearing optionality should not be built with the same emotional appetite as a 26-year-old growth maximalist. Structure follows context. That is a lesson far more valuable than any single ticker. The third model in the file is for the lower risk investor near or in retirement who wants safety, dividend cash flow, and another bucket alongside retirement accounts. The suggested mix leans heavily into SHD, then VOO, VXUS, and a modest broad growth exposure like VUG. With no allocation to the most aggressive category, File Site Fe Turn 27 File 5 Fe again. The wisdom is not that everyone near retirement should hold those exact percentages forever. The wisdom is that the taxable account has a different emotional and practical function. At that stage, cash flow matters more. Safety matters more. Volatility tolerance matters less. Yet even here, the file avoids becoming silly. It does not suggest replacing the whole account with a flashy covered call fund just because the investor is older. It still wants foundation. It still wants broad ownership. It still wants some growth. It simply changes the mix to reflect a different life problem. That is exactly how portfolio construction should work. Now, if I were telling this story in the plainest possible Buffett language, I would say it this way. A taxable brokerage is a freedom account, but freedom without structure becomes leakage. The account is wonderful because it is flexible. You can use it before retirement age. You can build a bridge to early retirement. You can fund opportunities, future optionality, even life transitions. But that same flexibility means the account must be built with more intention than people think. You have to respect taxes. You have to respect qualified versus ordinary income. You have to respect the difference between foundation, diversification, broad growth, and speculation. You have to resist the temptation to let the loudest yield or hottest performance chart become the whole strategy. That is why I think the best taxable brokerage portfolios feel a little boring at first glance: a qualified dividend value sleeve, a broad US foundation, a modest international diversifier, a broad growth engine, maybe a small aggressive sleeve, cash held intelligently, bonds kept out unless there is a very specific reason, no covered call yield cosplay in the taxable lane unless you truly understand what you are paying for in taxes and upside sacrifice. That is a grown-up account, and it is also why I think the original title idea is stronger than most people realize. Best ETFs for a taxable brokerage is not really about finding the 5 sexiest funds. It is about finding the 5 roles that let the account survive taxes and still compound intelligently. That is much more valuable because in the end, taxable investing is not about collecting tickers. It is about protecting compounding from your own carelessness. That is the real enemy. Not the market, not the news, not the next crash. Carelessness, the investor who respects structure, taxes, and job description, has a real chance to build something durable. The investor who shops taxable accounts the way a child shops candy will spend years confusing motion with intelligence. I prefer intelligence. It compounds better.